We prefer stuff that's kind of in the outskirts, kind of the growing markets. That's where we can really achieve the highest price per square foot because they're getting some of the better rental rates. Infill is traditionally made up of, older product, 70s, 80s, sometimes 90s construction, lower ceiling height. The, tenant base is a lot more established. The neighborhoods are a lot more established. That's why you really don't have as much growth kind of inside of a major city. But on the outside, that's when you get a little bit more opportunistic. You get into some of the communities that have really high-end home construction.
Welcome back.
Welcome back. Good to be back.
It's good to be back, man.
Back in the studio, back in the office.
That's right. And we've got a really, really cool topic today.
Yeah, we got a couple of them. They're good ones. And, what's funny is I always forget, and you always do a good job of it. I always forget, what are, good key questions or topics or something that, somebody would be interested in, just because there's so many.
Right.
And so it's easy to just try to stick to, either the build side or how do I make money here? How do I make money there? What, mistakes and things of that nature. But there's just so many good topics to it. And so I like some of the ones that we shoot back and forth. And some of these are good because, especially when you start dealing in the higher level and larger, real estate funds and institutions, as they get involved in it, I think it's just going to continue to explode the airspace.
That's right. And the topic today is, we talked a lot about
what is the topic?
It's really suspenseful.
Yeah.
We're gonna keep the topic away from you guys for another 5 minutes. Yeah. But no, quickly, the title or the topic today is how to sell your development.
Yeah.
To whom?
To the highest paying buyer.
That's right. And in understanding in your development who that end buyer is going to be, right? Because sometimes we're excited about Flexspace. We get so involved in find the right location, find the right cool building design, thinking of our tenants, that we don't spend a lot of time thinking about who our end buyer is going to be once we've developed the product, right? And so you want to, in the beginning, identify who potentially is going to buy your development, right? And so the larger your development is, the more institutionalized your buyer is going to be. And if that's so, you got to understand what are the metrics that they're looking at, right? What are their desires? What are their needs? And make sure you build it to that spec, right? And understand.
Correct. And, obviously the buyer pool for these is just so large and so vast as well, just as diverse as the tenant pool is.
Right.
And so a big misconception that I will tell you, and we run across it all the time, and Transit over there, and he'll tell you this too, how many people think that they're like, oh, we'll sell it at this low of a cap rate, we'll sell it to an institution. And it's like, institutions ain't buying this thing.
That's right.
Like if we took it to them, they never call us back, And so, but they're also not always the highest paying buyer either. Our highest sale price per square foot was through private individuals.
Yeah.
But each one is tailored to a little bit different. But yeah, it's a great topic, and it's something that I think the bar does kind of consistently move on as well a little bit.
Right.
So it's always good to stay updated and informed on that.
So we bought a small Flexspace building probably about 2 months ago, give or take. And it was a small, I think about 2,500 square foot building. So really small, right?
Yeah.
So this is not something an institutional guy is obviously going to look at. It's going to be mainly...
We're not going to take it to Blackstone.
Right,
no.
We're not going to take it to Blackstone. But so here's the stark difference of what we're talking about today, right? A small single tenant flex building is going to be an end user. It's going to be that tenant that you would usually have is going to be that buyer for that building, right? And in this case, it was us. And so we're also, interested in buying smaller flex space, single tenant kind of buildings that we can lease out. This turned out to be not the perfect one for us. So we ended up selling it and doing really great. We had a nice little 6-figure, I believe, exit, or I think maybe a little less. I don't remember actually, but close to 6-figure exit on this small little building that we sold in less than 30 days, right? And so it was kind of a cool thing, but this is a prime example of a building that an institutional guy is not going to look at. So going right into it, what is the right size type, first of all, that's going to start attracting the bigger buyer? Or what qualifies the building size to get to an institutional level?
Well, just to add on to what you just said, that profit margin for that small of a deal, that's more than I made in my first year of real estate. So, that's actually not bad.
Yeah, we were pretty happy with it. But also, not to get off topic. Also, I kind of regretted it. I was talking to Brandon that's over here as well, who's one of our guys in the office that takes care of acquisitions and just really a lot of things. He's the pro. He really is. Yeah. But we were talking about this yesterday is we probably should have kept that and just put it in our portfolio, because one of the things we want to do is
it would lease like that.
It would have leased immediately really fast. But some of the things that we were concerned about, like phase 1 and phase 2s, we were just like, you know what? Because we knew some things about the building that concerned us a little bit. So we were like, I don't know if we want to stick this in our portfolio. However, looking back at it, I would have done so. And as a good friend of mine said yesterday, he goes, you don't know until you lose a deal and you're like, oh, I should have or could have, right?
Oh, yeah.
And so the next few buildings that we're going to look at keeping them, putting in a portfolio. But anyways, yeah.
Yeah, but no, that's actually, like I said, that's pretty good profit margin.
Oh, yeah. It was a great little fast clip. So no regrets on that for sure.
Yeah. So as far as the institutional side, when you're dealing with some of these, really higher level individuals, some of their price points start at $50 million. So, and that's why you have so many smaller real estate funds, private individuals that kind of dedicate themselves to buying, a small bay industrial park here, and here, and then taking that and portfolio selling it to a larger group, right? Because they have a certain check size that they have to cut, and they really can't just go out unless it's maybe they own a bunch of stuff in the area and it's one just right next door and it kind of makes sense. But as far as especially entering a new market or something like that, a lot of institutions can't come in and just cut a $2, $3, $4, $5 million check and and buy a deal. It's got to be more substantial size. And also for the most part right now, they're mostly dealing in infill right across the country in major MSAs, major metroplexes, right? Houston, DFW, Atlanta, places like that. Also, they're really big on tilt wall construction. That's really their main, like when you take all of them and you go, what are the main things that they look for? They look for deep infill, tilt wall construction, right? That's kind of like their bread and butter. Now, they do continue to expand their perimeters just like real estate funds do, because there's several funds that I can tell you we talked to years ago that would never look at metal, would never look at tertiary markets. And since that time, we have sold several of those guys metal in tertiary markets. So parameters do expand. And I think it will continue to do that. But, unless your portfolio selling stuff, you're building stuff infill, you got the quality of the standards that they look for, even if they are going to do metal, it's going to be nicer, higher end metal, right? It's not going to be your low quality, efficient build with a gravel driveway. It's going to be full concrete, it's going to be very, very nice. And so, but not all the times, and that's, I think, a huge misconception. Not all the times institution buyers are your best buyers. But if you're aiming for that, the way to get the highest price is by selling them a brand as well, right?
Right.
They'll pay good money for that on top of the real estate. Kind of similar to, PS Business Parks, when they sold that. And just like in the self-storage side, right, like selling brands are huge. And that's why, the hotel side, it's also, a pretty big factor in those. So we say to build a brand on anything, just in general, because it does help a park out as far as, leasing, recognition, things of that nature. And, but yeah, those are going to be your main factors on the institutional side whenever they're looking at something.
So if kind of the institutional side of this is a minimum of $40 or $50 million check, right?
Yeah.
Is that what we're saying? Let's break that down further. What does that look like as far as like a size of the park? Is that like 200,000 square feet of a...
if you're 200,000 square feet at,
I know a lot of it's value per square foot.
Yeah.
Yeah, but is there an average number out there that
there's not, because
appropriate?
There's not, because each market kind of is a little bit different, right?
Sure,
so like Texas per square foot is different than Florida's per square foot. But out here, it's not uncommon for them to look at stuff that's, $20 and $30 million either, especially in our MSA. But as far as square foot goes, that's going to probably be starting around at least 150, 200,000 square feet.
And about $200 a square foot maybe starting, or...
No, that number is going to range, like, that's going to have a really wide range on it. Okay. And especially when you talk about infill, because some infill stuff, you got infill stuff that'll sell at $65, $70 a foot. I actually prefer, and I think a lot of the guys here, I mean, we prefer stuff that's kind of in the outskirts, kind of the growing markets. That's where we can really achieve the highest price per square foot because they're getting some of the better rental rates. Infill is traditionally made up of, older product, 70s, 80s, sometimes 90s construction, lower ceiling height. The tenant base is a lot more established, right? The neighborhoods are a lot more established. And so that's why you really don't have as much growth kind of inside of a major city. But on the outside, that's when you get, a little bit more opportunistic. You get into some of the communities that have really high-end home construction. You get into where a lot of these companies are growing and headed to, right? Just because you remember playing on Frisco 10 years ago, They were nothing. The same thing with, North Lake and Argyle. I mean, those were nothing too back then. I mean, you could have bought land, 10 years ago out there for, probably 50 cents a foot, maybe $1 a foot. Same thing on the Weatherford side. I mean, I actually bought land out there for 50 cents a foot that now sells for like $5 a foot. But being in those markets are the ones that we really, really like, where there's a lot of growth, but we can still kind of consider it infill because you're in the metro. You're not too far out. Those are the areas that we like the best.
Yeah, I imagine so. Now, we talked about some of our buyers. Of course, there's that single owner buyer, and then there's institutional. What's the middle?
Middle is going to be your private investor, right? Kind of like yourself. And then you got, real estate funds, you got private equity, you got family offices. Those are all going to kind of drift in the middle, and they kind of fight each other on, who's paying the most for whatever deal. But as far as like, your highest price per square foot, I mean, those are going to be your condo and owner user guys, right? Like those are the ones that you see going into 3 and 4s. Yeah. Even with interest rates where they're at right now, I mean, those are still booming. But, they're also very area specific as well. But I do like that. We've had a lot more people coming to us looking to do condo developments, which is, I think, pretty exciting.
And scary too.
A little bit. Yeah. You don't want to get,
they're going to be edging in, I think, standard Flexspace developers that are, like, there's going to be some competition in the future, I believe.
Yeah, and what happens with condos, and this happens in every condo project, over time, a tenant will leave, or a guy that owns a park will leave, and maybe an investor will buy it, and
that's right.
Then they're trying to lease it, and then another investor will buy another unit, and they're trying to lease it, and the next thing you know, you got 30 investors all fist fighting each other.
That's right.
For who's got the lowest rate in the condo.
That's why I say, if you're buying, my personal opinion, if you're buying in a condo development as an investor to lease out, be very careful.
Very careful.
It's you and 5 or 10 or 20 other guys, like you said.
A lot of people.
Yeah, that's a lot of people. And then it's just going to be about who can go the lowest. And if you got interest on it and someone else bought it for cash and just needs a little bit of cash flow, you're out. You're out, man.
Oh yeah, I'll give you a perfect. This is a perfect example. I bought a duplex back in 2008 in Arlington. And it was in a little neighborhood that a home developer or duplex developer 30 years prior had built all these duplexes. And I bought one. It was in foreclosure, and I'd never owned a duplex before. I'd owned single family rental. And anyways, I bought it. And, I thought I could rent it for a little bit higher than what I did. And, that's kind of when I learned, I mean, every duplex in that place was owned by a different person. Jeez. You can only paint a duplex so many times until your rent's capped out.
Right.
But yeah, it's very similar in the condo project. And so they're great for owner users. Like if you're going to run your business out of there
100%. Yeah.
And you're like, hey, we're going to sit here and it's going to be a great location for it. It works perfectly fine. Hey, owning over renting, obviously a lot of people say that's got its benefits. But if you're an investor, and you'd be surprised how many investors buy condo units, and it's because they're on the cheaper side, so you can get in at a lower basis than buying a full park. But yeah, history shows, research data, everything kind of shows that those things can devalue in rents over time.
Right. Now, I think there is a difference between like a silo unit. I don't know if that's the right word, but versus connected walls. If it's like a separate building, but it's in a condo type style setting, where you have an HOA and you share like the landscaping, the fence, the security fence, stuff like that. I think in that sense, it's probably okay because there's a lot of office
definitely better than
buildings.
A shared wall.
Right. The shared wall thing is just crazy to me.
Yeah.
That they're buying for investments. Anyways.
It's a big thing though.
It is a big thing.
A lot of people, yeah. There's a park, the one that you visited.
By the way, we'll develop it for you if you need it.
That park that you visited the other week, the condos out there, some of those are sold to investors and some to owner users.
Really?
Yeah.
The ones where the interconnected walls?
Correct.
I did not know that.
Yeah.
That's
and
interesting.
it's several different investors in there. So when that developer built it, they just said, hey, who wants to buy it? And so some they sold to owner users, some they sold to investors.
Wow.
And there already is a little bit of investor leasing fighting going on in there.
I bet.
With several units.
Yeah.
So,
Nasty. I want to stay out of that.
yeah. Nasty. I
So
want to stay out of that.
So we talked about deal size. We talked about the type of buyers. Did we get into maybe what some of those institutions look for specifically, other than just obviously the check size?
You know,
We talked about tilt wall. Anything else you want to add to that before we?
Yeah, you know what's funny is they're also, and a lot of times many of those guys are staying larger than 2,000 square feet. Like a lot of those guys don't like stuff that small either. Like they like to get a little bit larger because they're not as used to as much turnover, right? And that's a lot more management intensive for some of those guys.
Yeah, we talked about that.
Oh yeah, it can be, and that's why you always want to hire a third party if you don't want to do it yourself.
Right.
But you know, they sometimes look for tenants that are a little bit larger. They'll sometimes, each institution is going to be a little bit different, but some will have a office to warehouse ratio that's a little bit different, right? Some will say the whole project needs to be at least 10% or 90% warehouse, 10% office. Some may be a little heavier. A lot of them stay away from the 50-50, which I don't know if you know, that's actually what the original Flex term when I started in the business, that's what that was
Wow.
50% office, 50% warehouse.
Yeah.
And nobody knows that anymore. Nobody uses that anymore. But a lot of them try to stay away from that because that's a heavier office finish out. When you have heavier office finish out, you generally have, you know, a lot more in TIs that you spend. There's a lot more construction, not as easy of a tenant rollover that you can do just by getting someone out and putting a new tenant back in. So each one has a little bit different parameters on what they look for on that scope. But no, that's really your main things. If you're like, I got to sell to an institution, then you got to have a good brand that you're selling with a good park. Got to be infill, you know, tilt wall, all concrete. You know, it's got to have really all those factors to make it run. And then now you got to have the square footage amount, whether it's this park here or these two parks combined to make it to the value that they need to buy it. But I think you're going to have, which you already have now, but really over the next 5 to 10 years, you're going to have more real estate funds and private investors dedicated to buying parks nearby that are similar so they can continue to portfolio, sell to the larger guys.
That's right. When a developer is kind of on the front end, how do they make that decision between metal and tilt wall?
I'll tell you how most of them make it is by price, right? You know, you look at a price on metal and then you look at tilt wall and it's kind of like a no-brainer. The ones that we see do tilt wall a lot of times is because they have to, right? Because of the zoning, because of the city, because of whatever code, you know, it is on the zoning that they need to do. Some will do the metal with the facade on it, as you see. I'll tell you, over 80% of the construction across the U.S. is for new flex is metal construction. And there's a reason for that. It's because of cost savings. But also what you can do with metal, and is what you've seen on some of the stuff you're working on, metal today is significantly different than metal 10 years ago.
100%, yeah.
It looks, there's so many different ways that you can shape it, make it look fantastic. We see a lot of metal complexes getting much higher rents than deep infill spaces all the time.
Wow.
Right? Like you go through Arlington and Grand Prairie, I mean, you're not going to find, you know, $16, $18 plus triple net, right, on the tilt wall stuff. But if you go just a little bit north of Fort Worth, you know, north of Dallas, you'll find straight up metal construction getting those numbers.
Yeah.
With the nets being less than they are deep infill, right? Because their operating expenses aren't as much typically. Their taxes and insurance sometimes are a little bit less if you're in the county. So, you know, that's also a big misconception is people not understanding that rates, you know, can be significantly different from infill to outskirts. But metal construction is also one of the easier ones for new developers to get into as well, because as you know, you can go to a metal building builder and say, hey, I need 5 buildings put here, all 10,000 feet. And they're like, easy, do that in our sleep. And so, you know, but I like the metal. I prefer the metal, to be honest with you. I feel like when you go to replace a roof on a tilt wall, it's really, it's a heavy number because a lot of those are TPO roofs. You know, you don't really see much tar and gravel anymore, but those roofs are very expensive to replace. And I mean, a metal roof is too, but a metal roof can get dinged, it can get dented, and it's still fine.
Well, the good thing about tilt wall, you can actually do a metal roof on them as well and just do your parapets, raise those up a little, and then have a single slope or even, single slope roof on it, metal roof. So There's ways around it. But I think we talked about this too, that tilt wall starts really making sense above 100,000 square feet. I think it was you that told me that.
Yeah, because
as far as
when you're building
pricing,
it,
right,
when you're
the
building
concrete.
it's really a volume game on it.
Yeah.
And that's why you have the big box developers that build big box industrial. That's why a lot of those guys were speccing massive builds, because if you do, 100,000 feet or whatnot, you're at maybe, $100 or whatever for the concrete itself. But when you start getting down to like 300, 400, 500,000 square feet, it's now like you see that scale and you're like, oh, now it's 65 a foot. Now it's 55 a foot. Like it's a lot less. And so it's a scale game. And that's why you don't see as much of it happening on the flex side, because nobody's building 400,000 square feet of small bay.
That's right.
That'd be an enormous park.
Yeah, that's a lot.
It'd be out of control. Yeah.
That's a scrap metal yard.
Oh, yeah. And so many guys would build it too with just one entrance.
Right. Yeah, that's right.
But yeah, that's really the thing is if you're gonna do tilt wall, you gotta do it on scale, because there's several parks out here that there's a couple of them that people did new construction tilt wall not far from here, out here in Haltom, and I think they were like 20,000 feet, 30,000 feet, and the price was astronomical.
Here's a question: why do people sell before it's leased?
That's a big thing. We had a guy on the other week that, their group did that. We're seeing a lot more and more people do it. We're getting a lot more calls from people going, hey, we bought this land and we thought we were going to build a flex on it. We decided not to. Can you sell it shovel ready? As we know, shovel ready. I think people just put that on the end of their sentence now with land.
Right.
They just say it's shovel ready when it's not.
Right.
But there's a lot of people that it's been a common theme that we've seen a lot more, where people will start building a project and then look to exit it. And there's usually several stages of that. They'll either sell it while it's in construction, or when it just completed, or when maybe they got to 20 or 30% lease, which is what those guys did. But there's a few factors in why people do that. Sometimes it's partnership issues, right? Sometimes the build, there's one we're working on, the build took significantly longer than they thought, about 1.5 years longer than they thought, which is a long time. Some have a good basis in it to where they can take a little bit of money and run. Some are on a construction loan that are still very, very friendly, and now when it comes to refi, it's not as friendly. So it just really all depends on the stance that they're in. We don't prefer to sell stuff while it's under construction, just because that's such a risk, I think, for a buyer and a seller. Even though you go out there, and especially if you know metal construction, you can look at it and go, okay, I can see what's missing and what's not. That's what's great about Flex is the problems are usually stuff that you can visually see with your eyes, right? Instead of going into a multifamily deal or something like that, where you don't know what each unit had, you don't know if this hoarder's, you don't know what this person's doing, and so that's what's good about Flex. But buyers always have to be a little cautious. We worked on a project that the owner was trying to get out of because he was having trouble getting his septic permit after it was put in, and they were having a lot of issues there, and he just wanted to push it off to a buyer. Well, that's a big risk for a buyer, because you're kind of going in blind. You don't even know. I mean, you got to do a lot of research. You got to talk to the septic guys. You got to go talk to the city. You got to figure out, all right, where's the gap here? How do I fix it? How am I better than this guy? But there's a lot of reasons people do it, and a lot of times is to capitalize, because Flex is doing very well on the sales side right now. There's a lot of people that will buy something that's brand new construction, even if it's empty. And so, there's opportunity for that. Lending's a little tougher though, right? When you go to buy something that's vacant or still under construction, you're usually getting, a bridge loan or a high interest construction loan or something of that nature. Some people have done hard money loans. We've even seen people raise through private equity and just buy a deal all cash, finish it up, refinance it. So there's a lot of different reasons that people do it. But like I said, we don't advise it.
Right.
Because usually when you're under contract is when just all these things start popping up, and they're like, oh yeah, we didn't do that either.
Right.
Oh, you know what? Forgot to tell you, we didn't do that either.
Jeez.
And so it always
That's a
happens.
mess.
Yeah, it is.
I can see that already. Yeah, we, of course, we're still very heavy on the single family side as well. And every now and then we'll get a lead that comes in, and it's somebody trying to sell off a house that is in mid construction, and we just don't ever buy those. We're not interested in it, because we know it's just, there's a reason why they're selling it. And sometimes it's not just financial. It could be complications with permitting, with maybe the MAP drawings, the way it was drawn up. It's not going to be a good finish out. You know what I'm saying? It's not going to be a good property, a good quality property. And they know it. And so they're trying to get out of it now. And so we don't even touch those. We won't even consider conversation unless we can buy it at lot value. Yeah. If it's lot value, baby, we might just tear it down and start from the beginning.
Just sell the wood and move on. Well, one of our guys here is leasing a project that was, almost finished construction, and then it wasn't even like a tornado or anything that came through here because all the other buildings around it are fine. It was just one of those heavy wind days. Remember we had like 70-mile-an-hour winds?
Oh, yeah.
It like crushed the building in.
Yeah, I remember seeing that like in the news of just like buildings by building, just like sideways.
It crushed it in, and when you looked at that building, how it was built, it didn't have the crossover cables on it or anything, and so wasn't as sturdy as it probably could and should have been. But that's the issue with while under construction. Right.
Going back to the institutional buyers, we talked about deal size, we talked about building type. What are some other qualities that these institutional guys need to check? Like, are they a little bit more, I guess, picky on the type of tenants that you have, how long the leases are? Yeah. Like, what are some other specifics that might be helpful to developers out there?
So a lot of them will also have what some people call a WALT, a weighted average lease term that they like to see, right? Some like to see a certain type of lease term that is an average over all of the tenants there, right? Whether it's 2 years, 3 years, whatever that is. As far as tenants go, I will tell you almost all of them, not all of them, but almost all of them do not like automotive.
Yeah.
No automotive. They see someone out there working on a car.
Yeah, bad sign.
I don't care if it's me and Michael Tran trying to jumpstart one of ours. They're out of there, And so they don't like automotive. They don't like stuff that's heavy chemical. They're really weary about environmental issues. And as you know, Flex, you can have a lot of tenants that have it. We sold a project out there in Louisville, and it was a cleaner company that mixed their own chemicals to make their own cleaner, right? Like pool cleaners, things of that nature. And they mixed it all there, and it was a really nice facility. But what happened one night, and this is obviously, while it was under contract, one of the big old, I don't know what those are, that have like 100 gallons in them, was leaking, and it leaked onto the ground and actually ate through the concrete into the ground. So then obviously the environmentalists saw that. So now they had to do a phase 2. Then phase 2 guys said, you got to dig this out. And so it just turned into a whole mess. So that's why a lot of times when they see these chemical guys, they're just kind of like, no, we're good. Car guys, no, we're good. Body shops, no, we're all right. Mm-hmm. So, they really like your, contractor businesses, they don't mind, the private guys that are running, private gyms and things of that nature, like none of those are really scary to them. But as soon as they see a car with some oil underneath it,
right, that's a bad sign.
And none of my cars can park there, apparently.
And what's crazy too is that a lot of the parks that I've seen that have multiple automotive type shops, they literally look like just a scrapyard. Yeah. There's cars in the middle of the parking lot and all sorts of disrepair. There's oil leaks everywhere. It just kind of like creates an environment of just sloppiness, and I mean, I don't know. It's crazy. And now we need repair shops. Well, so I'm not against repair shops, but how is there a way to create the park that's safe? And I don't know.
There's some things that you can do. And let me tell you, I mean, there are parks that people have that are dedicated to automotive.
Yeah.
And, people can laugh at those guys all day long. Institutions or, some of these other funds won't buy them. But I'll tell you, when those guys go to their mailbox, cash just falls straight out of them. Like, you can make fun of them all day long, but I mean,
I bet, yeah.
Those automotive shops can sometimes charge really high dollar rents.
Yeah.
And so that's why we do have some buyers that come in there like, we ain't scared of automotive. We love automotive. They pay money. They pay money.
Okay.
But you're having to consistently, property management's a little bit more and whatnot. But oh yeah, they probably open their PO box and just money's just falling out of there. But one thing that you can do, and we actually have a guy doing it on one park right now, is he's opened it up to automotive. They're real picky on it though. They go look at other locations, right? So if you want to lease there, we'll go check out your location. Yeah. But what they're doing on this one is they actually have a storage yard that's the same size as the space that they're leasing. So their units are about 1,500 square feet. So they've got yard space that's about 1,500 square feet that's at the back of the property. And they say any car you have goes in that fenced-in area. So you kind of keep it all back there. Now, it doesn't eliminate environmental issues, right? But it keeps it out of sight, out of mind almost. Yeah. And it keeps the park a lot cleaner. It makes these guys, conform to, a little bit more rules and regulations. And so I like doing something like that because you can't really force automotive guys to just send cars off to go to, a storage yard or something like that, I mean, they got to be close by.
Sure.
Body shops are the ones that really bring in cars the fastest amount of volume, right?
Yeah.
Like our guys can lease to a body shop today, and then tomorrow there's gonna be like 16 Nissan Altimas out there that need new fenders. And
Why Nissan Altimas, man?
That's just the ultimate car that just needs that needs a bumper replaced. It seems like, isn't that right?
Yeah, for real. No, you ain't lying, bro. You are not lying, man.
I mean, I've yet to see an Altima that doesn't have a donut on it. To this
or
day.
a dent.
They come from the factory
Yeah,
with the donut.
bro.
Yeah.
Oh man, that's so.
And a blown out bass speaker in the back.
That's
That's
right.
just how they come.
Right.
But that's what I'm saying. And so
Disheveled hair and
reverse doesn't work.
wearing their slippers in Walmart.
Dude, yeah.
Oh, this is awful. If you have a Nissan Altima, we love you.
It's a great car.
We appreciate you.
It's a great car to have.
Don't take it personal.
We may need a donut one day.
Yeah.
From you, so you never know.
Man, I think this was great. Hopefully this helps some developers to think a little bit more creative and purposeful when creating your development and thinking like who your end buyer potentially can be. I think the pros of being able to deliver a development that an institutional buyer would look at is amazing, especially the deal size, right?
Yeah.
If you're wanting to sell $40, $50 million developments, those are going to be your buyers.
Yeah.
And we're seeing that happening more and more in this market. So yeah, hopefully you guys enjoy this. Please follow us, subscribe. Feel free to reach out to Cody for any broker needs. And if you need some investment needs, you can contact me as well.
There you go.
We got plenty of deals. Anything you want to add?
No, we got another event coming up. What day is it on, Tran? July 10th. We got a little Flex networking event with a little LP Expo mixed in there.
Let's go.
Is your place going to be done by then?
No.
No? All right, we'll do it at the shop in Dallas then.
Yeah, I know. we're in fact, I came there. That's why I was a little late.
Yeah.
I was there meeting with the contract, but we're getting there.
Yeah, that's all right.
But not by June.
No, but we're doing it back at the shop club, which I think you came to last time.
Such an amazing place.
Oh,
so
yeah.
cool.
It's an awesome place.
Fun.
So we're going to do it again. And what we're going to have there is we're going to have some people that are actually building, some folks that are building parks or buying land that are maybe looking to, get some money from anybody that's looking to invest with them.
Yeah.
And so it'd be another good time to network with some of those guys. And we like bringing those guys together. Some of these guys will be really good and experienced as well. Some are more newcomers, but a lot of good options.
Yeah. It's a great place to meet a lot of people. Appreciate it.
All right. Thanks, guys.